Futures markets they're a wonderful innovation. They're part of the economic landscape that people probably don't think a whole lot about. But when you have them and they're well functioning, they can unlock the doors to really get a lot more out of an economic activity.
Welcome to Smarter Markets, a weekly podcast featuring the icons and entrepreneurs of technology, commodities, and finance, ranting on the inadequacies of our systems and riffing on ideas for how to solve them. Together, we examine the questions: are we facing a crisis of information or a crisis of trust? And will building smarter markets be the antidote? This episode is brought to you in part by Abax Exchange, where trading in centrally cleared, physically deliverable LNG and carbon futures contracts is now underway. Ready for smarter markets?
Welcome back to Markets in Transition on Smarter Markets. I'm Dave Greely, Chief Economist at Abax Technologies. Our guest today is Brad Hitch, Director of LNG Trading at EQT. We'll be discussing the rapid development of the Gulf of Mexico LNG market, what it means for pricing dynamics, and how tools like physically deliverable futures contracts can empower traders to manage risk and unlock value. Hello, Brad. Welcome to Smarter Markets.
Thanks, David. Great to be here.
Well, I'm glad to have you here because I've learned a lot from you about the LNG markets and how they trade over the past few years. And I've really been looking forward to having you on Smarter Markets to share your trader's perspective on these markets with our listeners. This is our Markets in Transition series, and the U.S. Gulf of Mexico LNG market is certainly a market that's been in transition as the U.S. went from no LNG exports less than a decade ago to being the world's leading exporter today. Maybe we can start off with you bringing us up to speed on, what's been happening in the Gulf of Mexico LNG market.
It's an incredibly vibrant time for the market. The U.S. is over 100 cargoes a month at this point in time. It's pretty remarkable that it's done that within the space of 10 years, really. Less than 10 years, actually, when you go back to when the first projects got off the ground. You're continuing to see more and more new entrants, players of all shapes and sizes taking cargoes out on an FOB basis sometimes, U.S. volumes going all over the world. So it's an incredibly exciting moment we've reached, and it's not peaking yet. There's plenty more to come. So it's great.
And I was hoping you could put some of that size and the development of the market into some context for us. We often talk about the globalization of natural gas markets through LNG. How does what's happening in the U.S. Gulf of Mexico today compare to what was happening, say, in the North Sea during the formation of the Brent crude oil market in the 1980s?
That is a very good comparison, in my opinion, because, as the Brent contract was kind of gaining momentum, obviously within the North Sea, you had what was deemed to be and what was in fact a really good basis for starting that contract, in the sense that you had 60, 70 cargoes a month, something like that at the peak. And you had a lot of different players. So you had majors, you had traders. There was a good sort of distribution of companies that were in the North Sea at the time. If you compare that, though, to where we are in the Gulf today, well, now you're over 100 cargoes and growing in the Gulf at the moment. You've got dozens. I think I stopped counting when the number hit 25 or something a few years ago, in terms of players that have either primary capacity in the original terminals where they're either tolling or taking long-term contracts, or whether, there also have been some companies that have come in and bought primary capacity from some of the original holders, and doing that kind of further fragmenting the supply side. In terms of what that represents for the market, it's kind of an obvious thing in the sense that U.S. supply has grown, right? It's easy. You kind of look at U.S. volume, on a year-by-year basis growing, and you compare that to sort of the bigger players like Australia and Qatar, and you could see the U.S. catching up to those guys over the previous 10 years. But what's also really important about the growth of the U.S. market is that it's predominantly an FOB trade, which means that the volumes can go anywhere. It's coming from a wholesale market, which is radically different from the only other real example of LNG being pulled from a wholesale market is LNG coming out of Eastern Australia specifically. It has the ability to kind of be the volume that the market swings on. If you look through time, you've had big producing volumes, or you've had big concentration of volumes in single locations in the past in LNG, but you've never had that concentration of volume coupled with a completely fragmented supply side, and coupled with the ability for players to take those cargoes where they're needed most at whatever time. So, winter they go to Asia, summer they go to Europe, vice versa, South America during drier periods, Middle East when it's hot. They really can be the balancing volume for the market. And that's, I think, helping the LNG become a much more global and kind of more dependable commodity for a lot of new entrants.
And I want to come back to some of those points about what that means for price formation. But first, I wanted to ask you, where are we going from here in terms of volumes leaving the Gulf over the next few years? Like, are we done yet in terms of the level of development?
No, we're not done. There are projects slated to commission over the next couple of years, predominantly in Louisiana, some in Texas as well. And those are the projects that are under construction and have been for quite a while. In addition to that, there are, again, projects that have not yet taken FID in some instances, but appear to be on the cusp of doing so. So I think, where does it go from here? I don't think demand is going to be the constraint coming out of the US, that's for sure. To a certain extent, like really only scratching the surface in terms of global demand for gas. Obviously, as the volumes build out and as the infrastructure builds out, the space becomes a little bit more crowded in the US. It will be important to have the infrastructure to bring the gas, first of all, to the coast, and then also the ability to continue to build infrastructure on the coast to get the gas exported. But are we done? No. I think there's still a lot more to go.
And I wanted to ask you, from your point of view as an LNG trader, what does all of this mean in terms of price formation? In particular, when you look at the infrastructure build-outs occurring, how are you thinking about how the price of U.S. Gulf of Mexico LNG is determined and the price of pipeline natural gas at Henry Hub?
As far as the value or how price should be formed for LNG coming out of the Gulf, it is a market. These are volumes that can go anywhere. And so the simplest understanding of that should be that at this point, for FOB volume that can trade freely around the world, it really should be the best of market. So again, if Asia is predominant in a particular month and Asia is pulling the volume and paying the highest price, that should really dictate what the value of the LNG is here. If you go to another month and that's Europe or even South America, or as I mentioned, the Middle East or some of the emerging countries, it really should be what sets the price should be the marginal demand. And the marginal demand or the players that have access to US Gulf are pretty much all over the world, right? So it really should be the best of concept when you think about where price should be here.
And how do you see that as comparing to, say, the price of Henry Hub?
There are two components to that, right? Henry Hub, obviously, it's the gas market. It's not an LNG market. It's the gas market in the US. Obviously, it has been a big part of the US LNG story, has been people coming in, buying US LNG on formulas that create kind of a Henry Hub plus or a cost plus model for them, right? But at the end of the day, the price of gas in the US is going to be at times decoupled and in fact has almost always been decoupled from the value of the LNG in the Gulf simply because there is not enough transport capacity coming through the Gulf. So in other words, it's been very, very rare, for example, that the constraint on LNG coming out of the US has been price or demand, right? It's almost always been producing at max capacity or at least max available capacity. So, obviously you've had facilities go down and there's maintenance and things like that, but you've never had price determine a lower level in the LNG market outside, perhaps you'd say, of the pandemic year. And without that happening, there's really no reason why the two prices would couple.
Yeah, I think there's another common notion out there that you touched upon, which is that the price of LNG in the Gulf of Mexico is just a net back to Europe, a net back to TTF. What do you make of that idea?
I think if you're looking at it from one angle, I kind of understand why people arrive at that assumption. And Europe is obviously a very big gas market. It's also the most visible gas market. You have a TTF contract that people here can trade. And so in that respect, I think it's understandable that people would say, well, it should just be a netback from Europe because that's the thing that gets published the most, both in terms of the price, as well as, you get fundamental data out of Europe, right? You get storage levels that you can track. It's a relatively low hanging fruit in terms of if you're kind of trying to understand value. But again, if you think about it, Europe is sometimes the best value for LNG, sometimes it's not, right? When you think about the periods where it's not, one of the challenges that outsiders have in many instances is it isn't necessarily as visible what a price of what someone's paying for LNG, say in Southeast Asia or even China or South America. Those parts of the market being a little bit less visible tend to get priced into. So, to the extent people trade physical cargoes in the market, that pool will get priced into those physical cargoes, but it won't necessarily be reflected in the TTF price. It also bears mentioning, TTF is the gas market specifically in the Netherlands. There are obviously other gas markets in Europe that trade sometimes even to a positive differential to TTF. And even those markets close to TTF can have a role in kind of pulling volume away from the Netherlands and therefore kind of creating a higher LNG price relative to TTF.
It's not even true that the price of LNG off the coast of Northwest Europe is the same as the price of TTF in a pipeline in the Netherlands. We saw that during the European energy crisis following Russia's invasion of Ukraine, when LNG was pricing, something like $20 an MMBTO below TTF. How do you think that LNG in Europe should trade over time relative to TTF?
It's an interesting question. Obviously, when in the wake of the Russian invasion, when you had the skyrocketing TTF prices, you had an infrastructure bottleneck in Europe that a lot of people, myself included, I never imagined a situation where you'd have an infrastructure bottleneck for an extended period of time in Europe where they needed the gas, needed more LNG than they can get their hands on, right? And so that obviously was what was behind, some of these huge discounts or huge premiums for the TTF gas over LNG itself. We'd like to think we've backed off that situation now because we've got a lot more import capacity into Europe. There's a lot more caution in Europe about making sure gas storage is very, very full entering the winter and so on. You wouldn't expect to ever see that again, or at least if you did, it wouldn't be as persistent as it was. But it does beg the question, well, then what should happen? And, I think, again, there are going to be moments where you're going to need to pull a lot of LNG through into Europe relative to, kind of what the market might be doing from a day-to-day basis. So the market is set up in any given month to push some volume into Europe in a baseload way, irrespective to a certain extent of prices, and not necessarily irrespective of prices, but if prices kind of stay within a reasonable basis to what you could sell the LNG for in Asia, there's maybe even a little bit of inertia with that, right? Those volumes will just kind of flow in. And my guess is that will probably consistently happen at spreads that are maybe not enough to justify new regas, right? Because obviously, if you're not full in regas, if you're getting enough LNG into the system without completely maxing everything out, you're not necessarily going to see those spreads blow out. And so the LNG value will probably creep up relative to TTF. And it might even revert back to what we had before the Russian situation, where we consistently saw Northwest European LNG prices flat or even a premium to TTF, right? There was a moment, actually I shouldn't say a moment, there was a long period of time before the invasion where the best value of LNG in a tank in Northwest Europe was to stay in the tank and either be reloaded or possibly work as storage to be taken out later in the year.
And listening to you talk about the prices of the LNG cargoes, a couple things come to my mind is thinking about pricing off TTF because it's the price people can see. It's a little bit like the old story about searching for your keys under the light post because that's where the light is. But also there's a point of thinking about, well, when Europe is the demand pull, and when there isn't a bottleneck at regasification, then you could say, okay, maybe now it's a net back to TTF in that moment. But as you said, it's coming out of the Gulf, FOB, it's kind of a best of price at a moment in time. And when you're looking forward a month, 2 months, 3 months, you don't know what the best of price is going to be. So there's a lot of optionality, option value probably built into that and how you think about what you want to be trading. Could you walk a little bit through that mindset of thinking a little bit farther ahead on the market and what variables have to be taken into account?
Sure. If you're going out beyond, the very near term, And, you are looking in many instances to find an index to place your cargo against or to value your transaction against. That can be a little bit challenging when you're one of your primary tools, or maybe even the best one really from a liquidity standpoint, is a gas market, right? Because there is a basis differential between LNG, as we talked about a moment ago. That differential is going to be a little bit volatile. And it's going to be volatile in ways that are actually a little bit difficult to see if you're not in the LNG market on a consistent basis, right? So is the value of, as a prospective buyer, for the sake of argument, great, you maybe are filling your power plant or you're sourcing gas for your power plant through an LNG contract tied to TTF. Well, I mean, the minute that the basis changes, if you don't need the cargo anymore, you have a P&L position, right? It creates probably some risk for newer entrants. I think it creates risk where you're not necessarily ratable from day to day or month to month in terms of what your gas demand is. And you may need to put some gas back in the market or maybe take a little bit more on than what you thought. But at the same time, when people think about what index to use, and particularly I think this is, the case if you think about people with developing power projects in markets where the price itself is regulated, that regulator, and many times in these markets, will seek an index tied to a commodity price that's got a long history and is published and they can see, right? You're in a bit of a catch-22 in that instance, that you need a price formula that will remove the risk in your power purchase agreement in that particular instance. But the LNG market really isn't giving you, an index that isn't going to create some basis risk for you in the event that you don't need all of that LNG.
Yeah, and I wanted to ask you about the tools that are available when those indices aren't, necessarily good enough. And I'd like to talk to you a bit about how the availability of the tools changes the way that you trade. You've been a big proponent of physically deliverable futures contracts for LNG. So I wanted to ask you, why is that? And how do they change the way you can trade relative to, say, a cash-settled index contract?
Well, in the example I just gave of a power producer that needs to match his index to his PPA, having a physically settled futures contract or physical settlement tied to an index that you can work with gives you price convergence, or gives you something very, very close to price convergence, right? And so the convergence of the price to the actual market means the convergence of the actual index itself to the actual market, which, removes a lot of basis risk, particularly for developers, in my opinion. But going beyond that, to the extent it's a futures contract itself, obviously, it makes it a lot easier for new entrants to come in. You're always going, as a new entrant, probably to have some bilateral agreements you're going to need to put in place with the spot market, no matter what. But if you think about the ability to go through a clearing broker and give yourself access to the wider market, as opposed to needing to put in place 40 or 50 enabling agreements in a relatively short period of time, it's a great boon to get new people into the market and let them begin managing some risk relatively early. There's the other thing that people, if you've only ever traded LNG, you haven't necessarily experienced the freedom of optimizing a position without necessarily knowing where that cargo is going to have to go or where that volume is going to have to go. So if you think about this in the context of a gas market, if you're a producer and you have the ability to deliver into the forward market, you can hedge without thinking about, am I going to get stuck because I don't have supply going into that market? You can put positions on, you can take them off. And again, when more and more as you kind of get new entrants coming in, a lot of times if you haven't, had 10 years to kind of build out an LNG portfolio, you're going to have moments in time, if you're running ships, for example, where you're going to have a couple of cargoes here and there, or maybe an excess ship for a month and things like that. And having a futures contract that's physically settled gives you a lot more comfort, really, in optimizing kind of these odd lot positions, as it were. It makes it a lot easier to make a decision of, I only need half of a ship. Do I take a ship, or do I just hedge the cargoes out, forward sell them, and be comfortable with that? So I think it really touches a lot of levels, in my opinion.
One of the things was brought up in your response was this idea that there's a certain interplay between the markets and the tools available to the market, that you need a certain amount of liquidity, of course, to get a futures contract going, but then also having a physically deliverable futures contract can help by lowering the cost of new entrants coming into the market and being able to trade. How important is tools like that to helping markets continue to develop?
It's very important. The experience in my career that hasn't been in LNG has probably predominantly been in European gas. I got to be a part of the development of the European gas markets over a 20-year period where you started with really one market in the United Kingdom, that's the NBP. And, you grew to a place where the TTF contract not only came out, was developed, and really kind of took over the world, at least in terms of European gas. And, a lot of what happened with that in the continent is that as you had the liquidity build in TTF, and bearing in mind too, there had been, the TTF contract was a success after there had been many attempts to sort of develop traded contracts in Europe and different places, Germany and a few others. And there was a hub concept and all kinds of things. But by sort of lowering the bar for people to be able to trade the physical gas market, and that was done. One of the beautiful things about the design of the TTF and is it being an entry-exit system, you don't necessarily have to think as much about transportation in and out if you only want to trade. And so it pulls a lot of the liquidity into a central point and acts, even in the forward market, the OTC market, it acts very much like a physical future in that respect. And by doing that, sort of created momentum for itself where it only began to make sense that, whatever risk you were managing, you would go to that market because one, it was the easiest. And two, the minute that you began to price things against different indices, now all of a sudden, the reality was because everyone else was adopting it, you kind of had to. You couldn't do necessarily oil-linked contracts on a long-term basis anymore the way people always had, because it was going to create huge disparities in your P&L relative to what your peers were doing. So I think getting the plumbing right is kind of how I look at that question to a certain extent. Getting a contract that works, getting a mechanism that works, goes a long way towards building liquidity. And that liquidity itself then goes a long way towards, it really just feeds on itself is I guess what I'm saying.
It's interesting you bring up the European gas markets. I'd love to get into that a little bit more with you, just because I remember in my own career back in the 2000s working on the European gas markets. Of course, it was very much like an NBP market in the UK and then an oil index contract on the continent and some small regional markets developing. And when you saw that transition from people trading NBP to trading TTF and moving off the oil index contracts, was it, predominantly that fact that the TTF got the plumbing right that made that transition, or were there other pieces along with it?
The NBP always had the plumbing right. The UK contract was always a good one. It was well designed, and it's very much kind of the basis for the way the other European contracts have kind of been rolled out, in my opinion. But the big differentiator was once you had the successful contract in Europe that functionally worked, and you had it in a location where you had a lot of gas coming through, right? The Netherlands, it ties into a lot of other gas markets in Europe. And critically, it was also trading in euros per megawatt hour, which is very helpful that it was in the currency of the actual market that people were buying and selling gas. And by doing that, what it enabled that contract to do really was become the tool of choice for the continent. As much as the UK market is a very big market, relative to the other European markets, it's not as big as Germany plus Netherlands plus France plus Italy combined, right? The minute that you had a good contract that worked across the broader environment, it took off. And what it's kind of done is it pulled the liquidity away from NBP that was there for many years because NBP was kind of the only European gas market people could trade, right? And so you had a lot of outsider liquidity come in because they needed the exposure, felt like they needed the exposure to Europe. And a lot of that outsider liquidity now has gone into TTF. And I would imagine the primary liquidity in NBP these days is really people that have physical gas positions in Europe, specifically in the United Kingdom to manage.
The right contract in the right location with the right physical supply flowing through it?
It was an amazing success. I remember sitting on a trading desk at one of the banks I worked with, talking to the continental trader. And I think I've told you this story. I'd seen like 8 or 9 attempts to get a contract on the continent going and thought, it'll never happen. This TTF thing will, it won't last. And there we were 8 months later, it was regaining liquidity just so fast. So that's the interesting thing. Once something works like that, it may take a little while, but it just seems like it catches on very, very quickly. Then you look back on it in hindsight and say, oh, of course that made sense, right? Why didn't we see it at the time?
I guess brings me back to LNG and the Gulf of Mexico. So we have a lot of physical supply flowing through there, as you talked about. But I wanted to ask you, because in the LNG market, you've obviously traded gas for a long time. You trade LNG. I think there are many traders in the LNG markets that are best described as pure physical traders that haven't used futures before. And I was wondering, if you could talk a little bit about how can physically deliverable futures markets change the way that they can trade? If you're a physical trader who hasn't really used futures before because they haven't been available, how can they use these types of tools to unlock and monetize the value in their fundamental trading views and the optionality in the physical infrastructure that wasn't previously available to them?
It gives you much, much better ability to do both of those things. So in terms of managing just your risk and thinking about the positions that you take, again, it frees you up when you think about, what am I going to do with this cargo in 6 months' time? I like this price. I want to lock in at least that price for this, but I don't know if I'm going to actually want to deliver to that one location. Or what am I going to do if I'm committed to selling to this particular customer to get this price? And now all of a sudden, be a lot better for me if I took that cargo elsewhere. Having a price converged contract really removes the need to involve a specific counterparty in a specific location from some of those decisions. And it frees you up really to trade your risk as risk. But the other part, the very important part, and I think an increasingly important part in LNG, is that it does allow you then to optimize your infrastructure position in a much better way. So if you have the ability to adjust cargoes between regions, it's kind of an obvious thing. You can put positions on in different regions and take them off. It also gives you a much better way to manage storage or to optimize or extract value out of your storage position, right? So when you see calendar spreads go up, you have the ability to potentially move volume from one time to another to take advantage of that. When time spreads collapse, you're inclined to sell more volume today and buy that back out of the market to cover, right? That very action itself, once that gets going, creates a little bit of liquidity in the curve. It also rewards people for having that infrastructure also, right? So if you think about it, in LNG, storage is very, very expensive relative to a lot of other markets. A lot of the gas markets outside of the US and outside of Europe, there aren't as many opportunities to have kind of a traditional underground storage, whether it's in, salt caverns or whether it's in depleted reservoirs. The ability to develop infrastructure in the LNG market is kind of at a high cost, and it's a premium thing. And, obviously though, the less storage you have, the less ability that you have for the infrastructure to absorb price shocks, to absorb demand or supply shocks, the more the price is going to have to basically be the thing that stabilizes the market in the event of a demand or a supply shock. And that, of course, then is going to feed the volatility. So the more you have that volatility, but the nice thing is once you begin to develop a curve and you begin to monetize the positions that you've taken in your infrastructure, storage, shipping, et cetera, that in turn creates the incentive to actually do more of those investments, which will be better for everyone in the long run, because then it gives the industry as a whole has an incentive to develop the infrastructure that will reduce some of the volatility in the basic price. And I think that's one of the things that when you look at what's happened over the last few years, the extent to which prices exploded in the wake of the Russian crisis has been one of those things that probably maybe slowed down development a little bit. I think it's picking back up now on the demand side. But obviously, when it's better to bring in new customers when they feel that I'm not going to wake up one morning and find that gas is $80 in a MMBtu, right? When I was kind of expecting it to be somewhere between, 8 and 15 or something like that.
It reminds me of earlier in our conversation today, thinking about the Gulf of Mexico market as it continues to develop, right? We're anticipating something like export capacity doubling over the next, say, call it 4 or 5 years. As you said, more cargoes connected to a market, the US market that has storage, has a lot of production, those cargoes potentially becoming the swing cargoes in a global market. it seems like that creates a lot of opportunity for being able to unlock optionality, to be able to optimize that infrastructure. How do you think about just the dynamics of what that opens up in the coming years?
It should give people the ability to monetize infrastructure again, which should encourage people to build infrastructure. And, you've seen that in the US gas market, right? You've seen that over time where, the availability to hedge has given people better ability to get funding for upstream projects or for gas storage, et cetera. But I think it will also probably give individual traders or people that would like to enter the market specifically to trade it will probably have more opportunities to do that. I think the way, at least in my experience working in a few different institutions, what is probably a little bit tough to do is just purely trade a fundamental position tied to TT, or not tied to TTF, but tied to LNG specifically, purely with financial instruments, because you don't have the prices converge, right? And so I think that once you get into that position where you're kind of building liquidity in these down the curve and different contracts and different tenors and things, then that opens the door for more people to come in that purely want to take a position in those things, which obviously helps to build the liquidity in that part of the curve, which again incentivizes then you to build infrastructure that you can in turn optimize. I feel like we're getting to the point in that market where maybe we're turning the corner into that part of it. For me, it feels like a long time coming. I first got involved in LNG in, I think, 2000. And even 25 years ago, it was the trading market of the future and seemed to be the trading market of the future for about 15 or 16 years there. But I think it really has developed over the last few years into something where there's just a lot more liquidity in the physical spot market, shorter tenors and fixed price and so on. But, to me, it feels like only a matter of time before you turn the corner into that liquidity developing into a good, well-defined painted curve. And then, in my opinion, it opens the door to that market development, in turn giving a lot back to the LNG market participants.
As you said, it's been the market of the future, I guess, for 20 years. When you think about the opportunities for traders and the world of LNG trading and the opportunities growing and evolving, how do you see that? And how do you see if someone out there is listening and a trader and they want to try to capture that opportunity, how do they do that? How do you go from what you're doing now to trying to capture some of the opportunities that you've been capturing?
A lot of this obviously depends on the context of where the person is coming from. If it is someone who's currently trading natural gas in the US, I think for the moment, one thing that I hope is that as you sort of have a bigger commercial growth of companies participating in LNG with their commercial teams here in the US, I think that hopefully gets more sort of market participants in the US or more individuals the ability to sort of get exposure to LNG. I think it's important that I mention it that way because the answer would be very different, to be honest, if we were sitting in London, Zurich, Singapore, Geneva, where you have a lot of physical traders that have LNG trading desks. And I think for people to get involved kind of as new entrants there, it can be a little bit straightforward, as in you go to a trader, you go to a producer and try and get on anywhere you can, be it fundamentals analysis or scheduling at the beginning or what have you, and get in the door that way. I think the opportunities in the US are a little bit tougher just because there isn't as much of it here right now. Though you do have obviously a lot of projects, project development. You're beginning to see with producers coming into the market, you're probably going to see more and more, I hope, to see more and more risk managed specifically here. So I think for people in this particular market, I would say initially maybe look for opportunities in business development if you can, because all the action in the US up until now has really been about getting these projects built. And that is not trading, right? If you're working on developing a project, it's not trading, but it gives you a lot of commercial exposure to what LNG is all about. Where are the customers? What are they doing? Why do they want to export? Under what circumstances will this customer export versus that? And what are the risk profiles? Right now, probably business development roles in the US are the thing that give you the most entry to that. But I can't help but think over the next few years that there will probably be more entry-level trading jobs as well.
And I guess my last question for you is, as you look out over the next few years, what are you most looking forward to seeing develop in the LNG markets?
I think displacement of refined products in parts of Asia is something I'm looking forward to. When you begin to see people having to think about the price impact of LNG versus diesel different parts of the emerging market. That to me will be a sign that we've arrived as a commodity. I'm very much looking forward to the liquidity growing. I'm looking forward to having the opportunity to work on storage and more shipping and have those things unlock, or using trading to unlock value in assets, and to be able to do that more and more in LNG. I think futures markets they're a wonderful innovation. They're part of the economic landscape that people probably don't think a whole lot about. But when you have them and they're well functioning, they can unlock the doors to really get a lot more out of an economic activity. Some of the things we've talked about and being able to optimize assets and positions, that's something that I'm personally very excited about, because I've seen that work in so many other markets. And because in my opinion, those tend to be kind of the funnest, most fun deals you can work on.
Thanks again to Brad Hitch, Director of LNG Trading at EQT. We hope you enjoyed the episode. This concludes our series, Markets in Transition. We'll be back next week with our new podcast series, Inside the Coffee House. We hope you'll join us.
This episode was brought to you in part by Abax Exchange, where trading in centrally cleared, physically deliverable LNG and carbon futures contracts is now underway. Ready for smarter markets? Contact us at onboarding@abax.exchange. That concludes this week's episode of Smarter Markets by Abax. For episode transcripts and additional episode information, including research, editorial, and video content, please visit smartermarkets.media. Please help more people discover the podcast by leaving a review on Apple Podcast, Spotify, YouTube, or your favorite podcast platform. Smarter Markets is presented for informational and entertainment purposes only. The information presented on Smarter Markets should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Smarter Markets are those of the participants and do not necessarily reflect those of the show's hosts or producer. Smarter Markets, its hosts, guests, employees, and producer, Abax Technologies, shall not be held liable for losses resulting from investment decisions based on informational viewpoints presented on Smarter Markets. Thank you for listening, and please join us again next week.